What is going on, guys? Welcome to my channel. I'm the covered call guy, and I am trying to create a $120,000 passive income portfolio using only covered call ETFs. Right now, my portfolio yields me about $72,000 a year, $6,000 a month, $1,400 a week, and about $200 per day. In about a week and a half, hopefully, I would have crossed $75,000 or at least hit $75,000. That is the goal coming in a week and a half left of 2025. So hopefully I have hit my mark. If not, I'm gonna be very sad, and you'll probably hear it in my voice going into 2026. All right, legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice, because I'm not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. Please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's get started. Today's video is going to be a generic overview. As you know, for those who are new, welcome. If you're new, this channel, my entire thesis for this channel is all about long-term thinking, long-term hold, semi-buy and forget. Just because income investing is, for the most part, you do have to check up on it. Not every other hour, but at least 1 to 3, 4 times a day, right? Check in the morning when the market opens, maybe just before lunch, and then after lunch, and then right before the market closes. You should at least look at your portfolio, see how it's doing, maybe buy the dip. But there is another group of the other side of income investing, and I've noticed that in the comments. So, of course, I want to make this video for you guys, right? I'm starting to see there is some split where people only buy 30% or higher. They want the maximum yield. So this video is for you, right? We're going to be talking about the high yield allocation warfare, because you are going to war. This is a type of mentality you should have when you are trying to engineer income in the world of volatility, decay, and regime shift, right? The core thesis for this video is that yield is easy. You can get those 50, 60, 70% yield. The survival part is hard. You may get those 50, 60, 70% payouts for 1 month, 2 months, 3 months, 4 months, even 6 months. But after that, once it starts hitting a year, is it actually maintaining it, right? For the most part, you might even hit a year, because we have been technically in a strong bull market for a whole year. So volatility and upward trend has been helpful. The survival part is hard, because maybe after a year, maybe we have a full down year of downtrend, and then what happens? So let's take a look at what I think would be the best strategy going forward for those who want to utilize high yield allocation. All right, let's just talk about the new rules of income, right? No more 60-40. Income investing after 2020 is no longer about dividends and duration. It is about engineering cash flow from volatility. The new tools: the collapse of traditional portfolio forced you out of sovereign bonds. Now you have high yield option distributing 20 to 100 plus annualized yield. But this evolution came at a cost, right? What is the cost? I think it's at least these four. At the minimum, I think it's at least these four. The first one, NAV erosion. Persistent erosion due to distribution rates exceeding total return. 2, asymmetric risk. You face capped upside but full downside participation. 3, concentration. Extreme risk in single stock exposures. And 4, volatility drag, right? The silent killer that compounds against you, that most people don't talk about. All right, so in a high yield options ETF, allocation architecture matters more than fund selection, right? Income without capital is a dead engine. What do I mean by that? Your structural operating system. This is how you should view it. This is how you should kind of do your basic quick due diligence. One is how to neutralize NAV decay. Two, how to reintroduce upside where it is structurally removed. Three, how to hedge drawdowns without killing income. And four, how to layer yield without creating fragility. All right, the machine behind the money. Modern high yield ETFs are not equity ownership vehicles. They are synthetic volatility harvesters. Right? Funds issued by YieldMax, Defiance, NEOS, and similar funds operate as derivative engines, monetizing IV rather than business growth. So you are kind of indirectly owning the underlying assets, or you don't even own it directly at all. Right? Owning without owning. Synthetic long constructions. Most high yield options ETF do not hold the underlying stock. Most people don't care or even bother to find out or care, right? They just see the yield and they buy it, right? Instead, so this is how they operate for synthetic. Instead, they replicate exposures using options. Buy, call, sell, put, same strike, same expiration. This creates a delta 1 exposure. Just means it behaves like a stock ownership, but without dividends, voting rights, or balance sheet durability. And then you ask yourself, where does the money come from, right? Where is that yield coming from? Is it fake or is it real? The yield machine. Once the synthetic long exists, the fund sells call options, collect premiums, and pay distributions. The curse, right? The downfall, the cons, the ugly. This short call generates massive distribution. That's why you see MSTY at over 100, but strictly capture ability to participate in any rallies. Right? The hidden bond. Excessive capital sits in mostly T-bills as collateral, creating a secondary income stream. Layer 1 is the option premium from the IV, and then layer 2 is risk-free rate collateral yield. All right, yield is a volatility signal. High yield does not mean generosity. It means risk is being priced aggressively, right? So we're going to look at some asset types, some IV, and yield potential. Utilities, typically low IV, low yield potential. Index ETF is moderate IV, moderate yield. Semiconductors, high IV, there you go, high yield, like CHPY at 40%. Right? Crypto equities, extreme IV, and therefore explosive yield potential. Right? Yield is the market's estimate of pain. 100% yield exists because the market believes a 50% drawdown is plausible, right? You are selling the fear, but you are also going to get hit with the fear. When people start exiting or it starts dying down, that's trade-off. Right? The portfolio ending mistake. You, at number one, the investor, buys a 50 to 7% yield ETF. Second, you buy it, the NAV falls 40%. Third, income shrinks with capital base. Yield becomes mathematically irrelevant. Income without capital is a dead engine. A lot of this happened with YieldMax investors. Right? Fighting NAV decay. How do we do this? Right? Reintroducing upside where it was sold. The primary structural flaws of cover call ETFs is capped upside. To fix this, you must, I'm not saying you must, but you should pair them with assets that have uncapped delta. For example, we're going to do a case study here with CHPY, CHPY plus SMH. CHPY is the YieldMax semi-options income, right, ETF. Semiconductors volatility harvester with a 40% yield. Upside is capped. It sells away the explosive rallies common in chips. The fix, you can pair it with SMH from Vanik semi ETF. Same sector exposure, but with uncapped upside. Pure equity explosives, exposures, holds NVDY, TSM, AVGO directly. So you can pair it. That way you're not losing. That way you can kind of buffer, right? So this is just an example of what you could do. All right, allocation logic and outcome, right? Ratio 1:1 or 2:1 for income to growth. Rows of yield fund monetizes the wiggle, right? The volatility. Growth funds capture the drift, the trend. The outcome, income remains high due to CHPY's massive yield. NAV erosion is offset by SMH uncapped growth, right? Bull markets no longer punish income holders. The index version, right? We looked at JEPQ, which is capped, plus QQQ, which is uncapped. Same logic, different volatility regime. So they're just the same, right? You can pair JEPQ with QQQ or QQI with QQQ. It's just examples here. All right, drawdowns, directions, and damage control. Hedging without neutering the portfolio. While pairing solves upside risk, it does not solve downside risk. When sector crashes, both CHPY and SMH fall. You need non-correlated assets. And case study, blocks plus WNTR. Blocks is the crypto equity income, uncapped upside intention, but massive drawdown risk, right? Crypto equities behave like a leverage beta. The hedge is the WNTR. It is the pretty much the inverse of it is short MicroStrategy, right? MSTR. It is the inverse exposure to MicroStrategy, income generated from selling puts. That's why the yield is over 90%. It rips higher during crypto stress events. So now here you're playing both sides, but in the crypto market. All right, the hedging rules. Hedges are asymmetrical, not equal weight. Max hedge ratio, I would say, is 90-10, with 90% being core and 10% being hedge. Your goal should be the hedge should dampen volatility, not neutralize the thesis. Additional examples like MSTY plus WNTR, right? Long MSTY income, long MSTR income plus short MSTR income creates a long short volatility arbitrage where both sides pay income and you're playing both sides of the market. All right, concentration is the silent killer, right? Single stock are like landmines. Single stock yields like ETFs like NVDY, MSTY, and TSLY are structural landmines. If the company fails or regulatory issue arises, you face idiosyncratic ruins, which just means you have that single stock just completely plunge, right, falling 50, 60, 70% all-time lows. Right? The rule here is no single ticker should be more than 2 to 5% of the total portfolio. Right? Then we have the aggregator solution of YieldMax, a funds of fund holding a basket of YieldMax ETF. It reduces idiosyncratic ruins by diversifying across 15 plus tickers. The trade-off, your trade risk for fees is like 1.28%. Use it when you don't want to babysit 20 positions. For those who are in, okay with the ultra high yield, that is the trade-off, right? You swing as high as you want, but you can also swing as low as the market pushes you. Yield layering architecture. And what I mean by that is how to stack income without collapsing the structure. Yield must be layered outward from stability to speculation. I'm broken down into 4 tiers. Tier 1 is the ballast, right? This is your most defensive. That's what it means. It's defensive, it's conservative, it's like a rock. It don't move much. It shouldn't move much. And if it does, it doesn't move more than your others. For examples, is treasuries, right? SGov, cash, 4 to 5% yield, 10 to 30% allocation. Your row here is dry powder. Your tier 2, the paycheck, right? Index and sector incomes should be about 15 to 40% yield where you're kind of aiming for. Don't go above it. That's when it gets even more riskier than you need to. 40 to 50% allocation. The row here is reliable cash flow. Tier 3 is your boosters, your single stocks, your cryptos. These are where you're pushing extremely high yields, 50 to 100% plus yield, right? 20 to 30% allocation. Your row is just supercharging the yield. And then tier 4 is your shock absorbers, inverse income, hedges, 5 to 10% allocation. It doesn't really need to be a huge allocation in your portfolio. 5 to 10% max, in my opinion. The row here, profit when portfolio bleeds. The allocation decision tree, right? So I just broke it down here. How to avoid buying yield traps. Before allocating to any new income ETF, run it through this filter. Is the underlying asset reliable long term? Is IV supporting yield without at the money selling? Is total return positive? Right? Check NAV plus distribution. Is NAV stabilizing? Can it be paired or hedged? If it fails one, reduce size or reject. It's that simple. I want to keep it simple. I think this is the most easiest and quickest way to determine if you should have it or not. Right? Execution is where portfolio die. What I mean by that is kill the auto drip on tier 3, right? Tier 3, the boosters. Reinvesting dividends into a decaying NAV is catching a falling knife. Take cash and sweep into tier 1 or 2, right? Your balance or your paycheck. Use threshold rebalancing. Market moves fast. Any plus 5% or more drift from target allocation equals immediate action, right? You need to know how to allocate um, correctly. And then tax strategy matters. All right, you should always favor index options that uses 1256 contracts and taxable accounts for the 60-40 tax split. Shelter single stock yields and IRAs if you're okay not using the money right now, right? Otherwise, it's okay with tax brokerage too, but I'm just saying, why pay taxes to Uncle Sam when you don't need to, right? Harvest losses aggressively. All right, my verdict here, yield is a weapon. Allocation is the safety. Use correctly, life-changing income. Use incorrectly, silent liquidation, right? Allocation is the difference. Know how to use your yield as a weapon, and as long as you do, and you allocating correctly into tier 1 and tier 2 positions, you're fine. That's okay. 100% okay. We are not here to hate on these high yields. It's just a matter of knowing how to use them to your advantage here, okay? And that's it. And that is my high yield allocation warfare style, right? If you found this educational, informative, creative, funny, anything good, and you got anything out of it, please leave me a subscribe, comment, and like. If you want to see more different topics or just any general idea you want to make a video on, let me know. Leave in the comments below. If I do not get back to you, leave it in the comments in the next video, because I said in multiple videos, as the channel is growing, sometimes I get a flood of comments, and I do my best. I try to allocate a minimum of 30 minutes to just replying to as much comments as possible, and also taking down notes as deep dive requests or commented. So if I haven't got to you, please don't be discouraged. Go ahead and leave those comments again in the next video, and keep doing that. I'm letting you know it is not spam. I am not considering that as spam. It's just your comment kind of got flooded out with newer comments, right? So go ahead and leave those comments. I encourage you to do so. It makes me feel like I'm doing something for the YouTube community, especially in the cover call and income investing environment and community. So I appreciate all comments, good, bad, ugly, beautiful. I appreciate them all. Thanks for watching, guys. Stay tuned. Catch you guys in the next.